To get regular updates, subscribe to our channel and click on the bell icon. Hello friends, welcome back to the Exambin's financial learning series. In this session, we are going to know about the recapitalization in financial sector and why it is very much needed at this point of time. Reserve Bank of India Governor has recently spoken about recapitalization of banks need to be done with a clear and structured foresight to safeguard the interest of the Indian banks. So what is recapitalization? Generally, recapitalization is a process of restructuring a company's debt and equity mixture, often with the aim of making a company's capital structure more stable or optimal. Recapitalization of banks means infusing additional capital, that is liquid money, into the banks in order to give them the liquidity needed to carry out lending and other banking functions. On that note, it is a positive sign that the Reserve Bank of India, as the banking sector's regulator, and the government, as the principal shareholder of these public sector banks, now are in consultations on the problem. So why did the liquidity crunch arose? The banking sector is badly affected by the buildup of gross non-performing assets, which led to liquidity crunch. It has also been observed that NPAs are heavily concentrated in public sector banks. Some public sector banks have NPAs in the range of 15 to 24%. This has resulted in slowdown in banks' lending to industry and retail growth, thus holding back private investment in economic growth. The prevalence of bad loans also presents a serious systemic risk to the financial system in India. So how much is the figures to worry about? Gross NPAs stood at almost 9.6% of the total bank loans at the end of the last financial year. Stressed advances are another 12% as of March 2017. Put together, the gross NPA and stressed advances, which is almost 22%. As much as 86.5% of gross non-performing assets are accounted by large borrowers who have borrowed more than 500 crore rupees. Total bad loans is reportedly being at rupees 9 trillion or 9 lakh crores. So what are the priorities in this regard? That is, in this regard with NPA and recapitalization. The NPA problem is settling the existing bad loans might require banks to write off a considerable sum, which would affect their capital provisioning, thereby requiring recapitalization. This is the main reason for recapitalization, because the loans is going to be written off. Written off means the bank will incur loss. To manage that loss, government has to recapitalize the banks. But given that NPAs are over 9 lakh crore rupees, a straightforward recapitalization of public sector banks would greatly strain the government's fiscal position. Furthermore, in the absence of deep governance reform, it is uncertain that the NPA problem will ever be solved. It is essential, therefore, that the structure of any bank bailout be such that future bad behavior is not incentivized. The second option is disinvestment. Besides capital infusion by the government, raising capital from the market by dilution of government equity and sales of non-core assets are also being considered. Dilution of government equity must be accompanied by a reduction in effective government control to make it an attractive buy for the private sector. The third option is incentive mechanism. This is a mechanism to hold poor performer banks accountable and incentivizing good performing banks. Such an approach will produce a stronger public sector banking system. Certainly, India cannot afford to pour in more money to the bad performers by penalizing good performers. We can see some of the public sector banks are holding NPA level as low as 5 to 6%, but some of the banks holding up to 20 to 24%. This is a very bad gap between the banks. So we are penalizing the good performing banks also by considering the bad performing banks. What are the steps taken so far in this regard? The government has made a budgetary provision of pumping in rupees 75,000 crore into the state-run banks for the 4-year period ending March 2019. On June 13, the Reserve Bank of India had drawn up a list of 500 largest defaulters and made public 12 of the largest among the larger list, and asked banks to get these accounts cleared through the National Company Law Tribunal. We will see about this National Company Law Tribunal in a separate session. Now we are not going to see deep into that. The 12 largest among the larger list as announced publicly. These 12 accounts comprise Bhushan Steel, Bhushan Power and Steel, Escher Steel, Lanco Infrastructure, Amtech Auto, Electro Steel, JP Infra, Alok Industries and Jyoti Structures, Era Infrastructure, ABG Shipyard and Money ISPAT, which together account for over a quarter of the total bad loans of 8 trillion, that is 9 trillion, that is 9 lakh crore rupees, of which rupees 6 lakh crore rupees are with public sector banks alone. We all see in the news that farmers are protesting in novel ways in Delhi for past few months for loan waivers. Most of the farmers would have got loan between rupees 1 lakh to 10 lakh. But the big fishes, big cats are enjoying loan write-offs, waivers, restructures, with thousands of crores being turned into bad assets by giving to corporates. We are all just waiting and watching these things in TV only. Let us know your comments regarding these loan write-offs, regarding farmer loan waivers, regarding corporate write-offs in the comments below, and we will respond to each and every comment that is being posted. Thank you for staying with us. Goodbye.